Financial crisis in the United States, a historical perspective. Financial crises are often seen as catastrophic events that shake the foundation of economies, and the United States has experienced several of them throughout its history. Each crisis has its own unique set of causes and consequences, but they share common elements of financial instability, market panic, and a subsequent recession or depression. Understanding these financial crises through a historical lens allows us to gain insight into how economic systems can unravel and how the country has responded to protect its financial system and citizens. The Panic of 1837, the first major economic crisis. The first major financial crisis in the United States occurred in 1837. Triggered by a combination of speculative land investments, a sharp decline in cotton prices, and the overextension of credit by banks, the Panic of 1837 caused widespread economic distress. The U.S. economy was largely based on agriculture, particularly cotton, and when cotton prices plummeted, it led to widespread bankruptcies and job losses. Banks that had extended easy credit were unable to meet the demands of depositors, leading to a cascade of bank failures. The aftermath of the Panic of 1837 resulted in a severe depression that lasted for several years. Unemployment soared, businesses failed, and the country was in economic turmoil. This crisis revealed the vulnerabilities of the early banking system and highlighted the need for a more regulated and stable financial structure, though it would take decades before systemic reforms would be implemented. The Panic of 1873, the Long Depression. The Panic of 1873 was another critical financial event in U.S. history, often seen as the starting point of what is known as the Long Depression. It was triggered by a banking collapse in Europe and the United States, which was worsened by the collapse of J. Cook & Company, a major investment bank. The bank's failure, coupled with an overexpansion of railroad construction and speculation, led to widespread panic. The aftermath of the panic was devastating. Over 18,000 businesses failed, and unemployment reached extremely high levels. The U.S. stock market took a significant hit, and the banking sector faced major challenges. The Long Depression, which followed the panic, lasted for over 20 years and was marked by stagnation and deflation in the economy. During this time, the federal government did not have a robust system in place to address the crisis, which exacerbated the economic pain felt by Americans. The Panic of 1893, a gold standard crisis. The Panic of 1893 was one of the most severe financial crises of the late 19th century and was primarily driven by the collapse of railroad companies and the depletion of gold reserves. The United States was on the gold standard at the time, which meant that the supply of money was limited by the amount of gold held by the government. When investors began to fear that the country's gold reserves were running low, there was a mass withdrawal of gold from the Treasury, which further strained the economy. The crisis led to the failure of nearly 500 banks and over 15,000 businesses. Unemployment soared to unprecedented levels, and the stock market fell sharply. The economic downturn of the 1890s also led to widespread social unrest, with labor strikes and protests against the economic inequality that became more apparent during the crisis. This period also marked the beginning of political debates over the gold standard, leading to the eventual shift toward a more flexible monetary system. The Great Depression, the worst economic crisis in U.S. history. The Great Depression, which began in 1929, remains the most significant and devastating financial crisis in the history of the United States. It was triggered by the stock market crash in October of that year, often referred to as Black Thursday and Black Tuesday. While the stock market crash was a key catalyst, it was only one of many factors that contributed to the depression, including the overproduction of goods, the collapse of the banking system, and a decline in international trade. The impact of the Great Depression was catastrophic. Unemployment reached around 25%, and the poverty rate soared. Thousands of banks failed, leaving depositors without their savings. The agricultural sector was hit hard, with widespread droughts and falling crop prices, leading to a mass exodus of families from the Midwest. The global nature of the Depression also led to a decline in international trade, further deepening the crisis. In response to the Great Depression, the U.S. government under President Franklin D. Roosevelt, implemented a series of reforms known as the New Deal. These programs aimed to provide relief to the unemployed, stabilize the banking system, and reform the financial markets to prevent future crises. The establishment of the Social Security Act, the Securities and Exchange Commission, SEC, and the Federal Deposit Insurance Corporation, FDIC, were direct responses to the financial instability of the time. The savings and loan crisis, the 1980s and early 1990s. In the 1980s and early 1990s, the United States experienced another financial crisis, this time centered on the savings and loan (S&L) industry. The crisis was caused by a combination of deregulation in the financial sector, risky lending practices, and poor management of S&L institutions. The deregulation allowed S&Ls to engage in more speculative investments, which led to massive losses when interest rates rose and the real estate market collapsed. By the time the crisis was over 1,000 S&L institutions had failed, and taxpayers were forced to bail out the industry to the tune of approximately $124 billion. The crisis led to significant changes in financial regulation and the eventual establishment of the Office of Thrift Supervision, OTS, to oversee the industry. While the S&L crisis did not lead to a nationwide economic depression, it highlighted the dangers of deregulation and the need for greater oversight in the financial sector. The 2008 financial crisis, the Great Recession. The 2008 financial crisis, known as the Great Recession, was the most recent major financial collapse in the United States. It was triggered by a combination of factors, including the bursting of the housing bubble, subprime mortgage lending, and excessive risk-taking by financial institutions. Banks and other financial institutions had become deeply involved in complex financial products such as mortgage-backed securities and collateralized debt obligations, CDOs, which were based on risky subprime mortgages. When the housing market collapsed and home prices plummeted, many of these financial products became worthless, leading to massive losses for banks. The failure of Lehman Brothers, a major investment bank, in September 2008 sent shockwaves through the global financial system. The U.S. government responded with emergency measures, including the Troubled Asset Relief Program, TARP, which provided bailouts to struggling banks, and the Federal Reserve lowered interest rates to stimulate the economy. The Great Recession led to the loss of millions of jobs, the collapse of major financial institutions, and a significant decline in the housing market. In the aftermath, financial regulations were overhauled, leading to the implementation of the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. These reforms were designed to prevent another crisis by increasing oversight and reducing risk-taking in the financial industry. Lessons learned and moving forward. Each financial crisis in U.S. history has been a learning experience, exposing weaknesses in the financial system and prompting reforms aimed at preventing future disasters. However, the cycle of boom and bust continues to be a characteristic feature of modern economies. While regulations such as the FDIC and the Dodd-Frank Act have helped stabilize the financial system, there are ongoing debates about the effectiveness of these measures. As financial markets continue to evolve, particularly with the rise of digital currencies and fintech innovations, it is crucial to stay vigilant. The lessons from the past, including the need for transparency, proper regulation, and responsible lending practices, should guide future policymakers as they work to protect the financial health of the nation. In conclusion, financial crises have shaped the economic landscape of the United States. From the panic of 1837 to the Great Recession of 2008, although the nature of the crisis has changed, the underlying causes, excessive speculation, poor financial oversight, and inadequate regulations, remain strikingly consistent. By understanding the historical context of these events, we can better prepare for and mitigate the impact of future financial upheavals. Thanks for watching. If you enjoyed this video, please like, subscribe, and hit the bell icon so you never miss an update. Drop a comment with your thoughts, and I'll see you in the next one.